The tax devastation of entity mistakes. 1. LLC does not equal tax status. The most common, and costly, error among entrepreneurs is misunderstanding the nature of an LLC. An LLC is a legal entity, not a tax status. Declaring I'm taxed as an LLC is meaningless in tax terms. Every LLC must elect how it will be taxed, as a sole proprietorship, partnership, S-Corporation, or C-Corporation. Without this election, the default for single-member LLCs is sole proprietorship, and for multi-member LLCs, partnership, both of which trigger self-employment tax. Footnote: LLCs offer flexibility, but defaulting without a tax election invites unnecessary taxation and audit risk. 2. Sole proprietorships are audit magnets. Operating as a sole proprietorship is the IRS equivalent of bringing a butter knife to a gunfight. It exposes all income to self-employment tax and flags your return for increased audit scrutiny. Why? Because sole proprietors file on Schedule C, for business, or Schedule E, for rentals, which lacks a balance sheet. The IRS sees that as one-sided reporting and inherently less trustworthy. Add the burden of 15.3% self-employment tax, and the structure is both costly and risky. Footnote: sole proprietorships invite audits, maximize self-employment tax, and provide no strategic flexibility. 3. Why entity structure dictates tax strategy. Tax structure dictates your ability to shift income, control distributions, manage payroll taxes, and legally minimize tax liabilities. Most attorneys focus on asset protection, but smart tax planning should drive entity design. For instance, electing S-Corporation status can save $15,000, $20,000 per year simply by reducing exposure to self-employment tax. Asset protection is important, but taxes are usually the heavier financial burden. Footnote: your tax burden is primarily determined by your entity type, not your lawyer's comfort zone. 4. The S-Corporation sweet spot. S-Corporations are ideal for small business owners actively involved in the business who are taking out most of the income annually. With an S-Corp, only the salary portion is subject to payroll taxes, distributions are not. Setting a reasonable salary and taking the rest as a distribution can legally reduce taxes by 5 figures. An added bonus? S-Corp are less likely to be audited due to their required use of both balance sheets and income statements. Footnote: S-Corporations allow income splitting between salary and distribution to legally lower taxes. 5. Never put real estate in an S-Corp. Real estate inside an S-Corporation is a tax booby trap. Rental income is not subject to self-employment tax, so you don't benefit from S-Corp treatment. Worse, if you ever need to move the property out of the entity, say, for refinancing, it triggers a taxable event. The IRS treats the transfer as a sale at fair market value. The result: phantom income and unnecessary taxes. Use a partnership instead for flexibility and favorable treatment. Footnote: real estate should never be held in an S-Corp due to inflexible rules and hidden tax consequences. 6. When C-Corp makes sense. C-Corporations can be powerful when profits are not fully distributed and instead reinvested in the business. At a flat 21% corporate tax rate, they allow more after-tax capital to stay in the business compared to S-Corp, which can top out at 29.6%. Add Section 1202, which enables zero capital gains on qualified stock held for 5 years, and C-Corp become formidable long-term wealth builders. Fringe benefits like unlimited medical expense deductions also apply. Footnote: C-Corporations allow retained earnings to compound at a lower tax rate and can eliminate capital gains with Section 1202. 7. Real-world comparison: $250,000 income. Using the same $250,000 net income, different tax structures yield drastically different after-tax results. Sole proprietorship or partnership, $90,000 tax, $160,000 kept. S Corporation, $70,000 tax, $180,000 kept. C Corporation, $60,000 tax, $190,000 retained, assuming reinvestment. The tax savings range from $20,000 to $30,000 annually just by choosing the right structure. Same business, same income, different outcomes. Footnote: choosing the optimal tax entity can boost retained income by tens of thousands each year. 8. Entity layering, the elite move. Advanced strategy involves layering multiple entities. Example: S Corporation for consulting income. C Corporation to own intellectual property and retain earnings. Management LLC, taxed as S-Corp, for staffing and services. This enables strategic income splitting, maximized deductions, strong asset protection, and audit defense. It's the approach used by high-earning entrepreneurs to structure wealth like a chessboard, not a coin toss. Footnote: using layered entities optimizes tax efficiency, asset protection, and flexibility across income streams. 9. The 50-50 partnership fix. S corporations lack flexibility for partners with unequal costs or contributions. A better setup: form an LLC taxed as a partnership. Each partner owns 50% through their own S corporation. This lets each partner deduct their own expenses, like vehicles, individually, rather than splitting them. One partner can write off a $100,000 SUV, the other, a $30,000 Toyota, without subsidizing each other. This creates fairness and tax efficiency. Footnote: structuring through an LLC owned by S-Corp offers custom deductions and partner-level control. 10. Start with an entity map. Begin by creating an entity map, a visual layout showing all entities, ownership percentages, and tax status. This tool helps tax advisors and attorneys design a strategy tailored to your goals. Half of your total tax savings will come from proper entity selection and structuring. Filing tax returns is compliance, designing your structure is strategy. Footnote: an entity map is the starting point for strategic tax planning that can unlock massive savings. 11. The wealthy don't wing it. You don't build wealth by default. You build it by design. Wealthy individuals behave differently, they use tailored entity structures, plan their taxes proactively, and align with government incentives. They separate real estate from business entities, use C-Corp for legacy planning, and structure holdings across states and verticals. Strategic design beats reactive compliance every time. Footnote: the wealthy structure entities intentionally to preserve capital and multiply after-tax returns.